equity mate.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, where we will help you learn to invest in 15 minutes or less. We break down the world of investing from beginning to dividend so that you can hopefully make some returns. My name's Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going, bro?
I'm good, Bryce. How are you?
Mate, can't complain. Footy finals.
Yeah. At this stage, this will get released on Sunday, so we will know who is playing in the prelim.
Yeah, big.
Yeah, so Sydney, Richmond, and Hawks, Collingwood, I'm guessing.
Really? You reckon Melbourne will get knocked out?
Have I guessed that side of it? Yeah, I think I've got the draw right. Yeah, Melbourne, Hawthorn. That'll be
You reckon
tight,
Hawks will beat Melbourne?
I think the Hawks will beat them, yeah.
I reckon Melbourne are that on the roll team at the moment.
Yeah. It's
You know how there's always one.
It's just, if the last 3 years are the Bulldogs win the granny, then Richmond, and then Melbourne, the AFL are just out of good storylines. Like
It's a great storyline.
But the three most hard done by teams win the flag in consecutive years. It's like, what do they got to, like, what's next?
Mate, when the
St Kilda?
Bombers win next week, when the next year, that's going to be a massive story.
Yeah, true. It's like all the Melbourne teams are back on their high horse.
Yeah, no, it won't be Saints, that's for sure. Or Carlton, no way. Collingwood would be big.
Collingwood would be big.
Mm-hmm.
We're recording this after our Melbourne show, before our Sydney show, and we are still in the first week of footy finals, so we're making some forecasts, both about footy and about the Sydney show. But so I think in this episode what we want to do is, after our Melbourne show, there was a theme to a lot of the questions, I guess we could say.
Yep.
One that I guess we probably had when we started investing as well was a lot of the thought was around stock picking, and it is the sort of the most daunting thing when you get started. You sign up for your ComSec or your IG or whoever, and you're faced with just a list of all these companies, and their prices are moving up and down, and there's all these ratios, and there's all this information, and you sort of just like, where do I go? How do I start? What do I filter on to try and pick a stock?
Yeah.
And something that we tried to get through in our Melbourne show, and we will be trying to get through in our Sydney show, is that don't spend so much time and energy thinking about that. Forget about stock picking, because that's not what is the most important thing.
Yeah, true. And it's a very stressful thing if you do it, and can lead to a lot of lost, hard-earned money, especially as a beginner.
A lot of lost confidence as well.
Yeah. And, all you have to do is look at the stats and see that the majority of the most professional money managers out there who dedicate their entire day and, the majority of their life to trying to pick stocks that perform better than the average market return, and statistically speaking, most of them can't even do it. So yes, it's fun to certainly sit back and try and pick stocks, and we're not saying at all by, don't give it a crack at all, but I think the message is don't get so hung up on it as a beginner right at the start, because there are much better ways of investing your money without having to try and, as you said, Ren, work out ratios or discounted cash flow methods and all this sort of stuff.
Yeah, so I think it's something like 30% of fund managers beat the S&P 500 index over any 3-year period. So, these are fund managers that are paid top dollar. They're professionals. They spend all their days trying to beat the market, and it's something like 30% of them actually do over any 3-year period. So
yeah, and the likelihood of us being in that 30% is
so
very small.
I guess what we want to do in this episode is reframe the thinking and talk about some of the things that you should think about when you're starting to invest, and when you've signed up for that broker and you're looking at that screen, and these are things that you can look for that will help you sort of dip your toe in the water, make the right decision, and get started.
Mm-hmm.
Because we both enjoy picking stocks, just for the sort of the learning experience and the love of the game.
Yeah, absolutely. Yeah.
But we both have experiences where we haven't picked so well.
Yeah.
For those who are new to the podcast, my notorious start to investing was picking Slater and Gordon, the legal stock, which managed to lose over 99% of its value. And I still hold it, but only because it's worth so little now that I can't cover the brokerage to sell it. So it's just sitting.
Which is absolutely classic.
Yeah, I know. It's actually unbelievable. But then at the same time, my second stock pick was something where I did really no more or no less research. I was still just as naive and wet behind the ears, but was A2 Milk, and I got very lucky on that. And so, stock picking in that instance was great for me. I more than covered all my losses in Slater and Gordon, but to say to you that there was any more thought behind it, or I just I got lucky.
Yeah, absolutely.
Yeah.
It's from the days of you picking Slater and Gordon and A2 Milk, and from the days of me buying Bellamy's, which is another story that we sort of go through in the show. We've both come to learn quite quickly that whilst we got lucky and Afterpay's been good, but as a long-term strategy, it's certainly one that is much more risky for you and I, who certainly don't spend all our days and have spent the majority of our lives doing what fund managers do day in and day out. And so I think what are some of the ways that we can make the most of it?
So to my mind, there's probably three things that should help you sort of frame how you think about the way you invest. There's probably more things that you want to add, so just chuck them in. But the three, for my mind, are reducing the costs you can control, and that's mainly around fees.
Yeah.
The second one is about diversification, and specifically when you think about, because diversification is a big word, but when you think about it, it's about diversifying risk. So I'll get into what I mean by that in a second. And then the third one is about asset allocation and about how much of your money you sort of put in the market generally, and then how much you keep for individual stock picking.
Yeah, nice.
So maybe we start at the beginning. Start with the thing that we always go on about here, which is around control what you can control, and that is the fees that you pay.
Yeah.
So obviously the immediately obvious one is brokerage. You want to minimize that because when you think about the brokerage that you pay, you think of it as the money that you've instantly lost buying that company, buying that share. So say you are with NAB Trade and they charge $20 a share, $20 a trade, and you put $1,000 in. When you spend that $1,000, you've instantly lost $20 on that trade, and you need to make that $20 up just to get back to even. The less you lose by entering a trade, by paying less for brokerage, or if you go with stake and you pay nothing for brokerage, but you lose a little bit on the exchange rate, then that's money that you have to make up just to get back to even.
And you need to look at it in terms of a percentage rather than a dollar figure. So $20 for brokerage, you need to look at it in terms of how much you're actually putting into the stock. So if you're investing $2,000, then that $20 is 1%. So you need your stock to essentially go up more than 1%. Hopefully it does, just for you to break even. But if you were at putting in $500, then, as a percentage, you need your stock to go up significantly more just for you to make that $20 back.
You didn't want to do that maths?
What are we looking, 4%?
Yeah, nice. Keeping you on your toes, mate.
Come on. So you need your stock to go up 4% to get your brokerage back. And it's something that I learned early on, something I didn't really consider. And then putting in small amounts, that $20 adds up over time, and you're putting in quite a significant amount into brokerage. So finding stock brokers that, give you access at a low cost is also important. Obviously, there's a number of other things that you need to consider when finding a broking platform, but cost should definitely be one of them.
Yeah, so that's the first way to keep your costs down. And the second one is about the fees that you pay when you're in a trade. So if you're, simply if you're paying 4% brokerage on a trade, you need to make that 4% back just to get back to even. If you're paying 2% fees to a fund manager, then you need to make that 2% back just to get even with what you would in the broader market. And I know that's a little bit confusing, but maybe if I use an example. So say the Australian market rises 6%, and you could have accessed that at basically no cost by just getting in a low cost ETF, or just buying, just a broad basket of stocks. But instead you go to a fund manager and you pay him 2%, then you would expect him to at least get that, that plus more. So you'd expect him to at least get, 8% returns to make up for his or her fees. When you're in a trade, when you're in a fund, even ETFs have fees. You just need to look at the amount of fees you're paying, and it's all about getting what you pay for. Because, some investors are worth every dollar, but obviously some aren't.
Yeah, 70% of them aren't.
Yeah. But the interesting thing is, it's not like, so that 30% over any 3-year period, it's not like it's the same 30% of funds over any 3-year period. And so what you see in, this is completely off topic, but what you see in big money managers, like superannuation funds and stuff, is that some of them chase performance. So investor A is in that 30% over a 3-year period. So then the super funds or whatever shift money to investor A, thinking that investor will continue to go well. But what happens is, as with everything in life, mean reversion happens. And so investor A goes back into the pack, and investor B is in that 30% over the next 3-year period. But the superannuation fund took money from investor B and put it with investor A. So sometimes you see these big money managers chasing performance, and in doing so, just getting stung by mean reversion every time and missing out on the outsized performance. So be patient. If you think an investor is a good investor and you like their strategy and they have a bad year or two, sometimes that means they're just on the cusp of doing something great.
Yeah. Now back on topic.
Yeah.
We need to move on. So we've now got, so cost is something to consider. And now the next thing to consider is diversify, or how you can diversification within the trades that you're doing. So this is obviously about, in some degree, risk, limiting your risk by spreading across a number of, it sort of goes into the next one as well in sort of allocation, but, diversifying can happen in a number of ways, be it through ETFs, listed investment companies, or by investing in a number of different industries.
So I think the important thing to think about here, because when people think about diversification, it's a big idea and there's a lot of things under it, but the way I think about it, and I think it makes it easier, is you want to diversify your sources of risk. So if you get in an ETF, a listed investment company, you get in a fund that is managed, and then you also get in a bunch of companies, but all of those things are invested in, large Australian companies, then you haven't done
same stuff.
Then you might be technically diversified in terms of you're holding lots of different assets, but really your risk sources are all the same. You're exposed to the Australian economy slowing down. You're exposed to shocks in the Australian share market, and you're particularly exposed to shocks in the large Australian companies and the large Australian banks, especially. So what the way that I think about diversification is, you want to diversify your sources of risk. So if something goes wrong in, say, the Australian market, the American market, the bond market, the foreign exchange market, that not all your investments will be impacted, or at least some will be positively impacted and others will be negatively impacted. So that means the main thing is being across different asset classes and different markets, asset classes, and to an extent industries. But you don't want a single source of failure. You don't want like the American energy market to tank and for all of your investments to hurt. You want something to be invested in, Indian, I don't know,
So a
transportation
practical
or
example
something.
would be, if you look at some of the things in my portfolio, you've got Brickworks, which is a listed investment company on the ASX, and they specialize in financial companies to some degree. So that's giving me exposure to that, and then on the flip side, I've got ETFs that are directly exposed to the Nasdaq 100. The index in or the sort of stock market in the US, so completely removed from Australian financials. I've got an oil ETF, crude oil, that literally just follows the price of crude oil, and then you've got some direct stocks as well. So among other things, but that's just an idea or an example, Ren, of what you're saying is the sources of those are all completely different. In some way, maybe correlated, but not directly. It's not like I'm exposed in all of them to the Nasdaq 100, for example.
Yeah. And when you think so, your oil ETF might be affected by war in the Middle East, and your Nasdaq ETF might be affected by China getting supremacy in artificial intelligence. But those two things probably aren't related. The price of oil probably isn't going to tank by China developing the world's best AI. So you just you think about what the risks are in the world, and then you make sure that all your stocks aren't going to fall because of it. Because of one.
So we've looked at cost, we've looked at diversifying your risk source, and now I guess the big question is allocation.
Yes.
So we're looking here. We're talking about, correct me if I'm wrong, Ren, is what we should be allocating into stocks, and also then in my mind in terms of weighting, and also I want to touch on consistency of allocation as well.
Yeah. So I think in terms of what the theme of this episode is, which is forget about stock picking. The main point that I want to make is that when you're allocating money into stocks, if you're young, most of it should be in stocks. At least sort of 75%, I would say at a minimum, should be in stocks. I don't know if you agree with that.
Well, let's just unpack that. So you're saying if you've saved and saved and saved, and you've got to a point where you want to put money in stocks, you're saying that you think 75% of that total pool of savings should be in stocks?
I think if you're under 30, yeah.
Interesting. Okay.
Yeah, I think even if if you're freaking out that the whole market's going to collapse tomorrow, I think if you have the temperament to hold through, I think, Well,
I just want to put a caveat on that. You should only have 75% of your total set pool of savings in stocks if you know that you're not going to need to draw on it in case of major emergency or anything like that.
Okay.
I think
everything that we say here should be caveated on what you've saved to invest. It shouldn't be what you're trying to spend on a house in the next 2 years, and it shouldn't be your rainy day fund, and it shouldn't be what you need to pay rent. This is all the money that is you've set aside for investing that you're not going to need to draw on. Yeah.
Yes.
So that's for everything that we've discussed on every episode, I think.
Yes. Yeah.
Need
to caveat that because we don't want anyone putting in their emergency dentist fund. No.
Yeah. But I guess what my point was going to be was when you think about the money that you're putting into stocks, understand that you're probably not going to be able to beat the market with your stock picking, and put the bulk of it just in a variety of, vanilla, low fee, diversified funds, whether that is, like the ASX, the S&P 500 in America, maybe even some emerging markets, or just some global funds that just get a broad market return every year and that don't cost a lot, and then have a sort of discretionary pot of money that then you can use to pick stocks. I think in terms of putting stock picking out of your mind and just getting in the market, I think that should be your focus. And then as you get more confident, and hopefully as you grow that discretionary pot, it means you can do some more stock picking. But I think that's sort of the important takeaway in terms of allocating your assets. Don't think that you need to put all the money that you're putting into the stock market into individual stocks that you pick yourself.
Yeah, no, I totally agree. And there's definitely a piece around being consistent with it as well. We speak about dollar cost averaging, and as you said, Ren, especially for people our age, younger in the market, the long-term benefits of averaging your way into stocks is quite profound. It certainly minimizes your risk, and I think one of the best ways that you can do that is through a Vanguard ETF. For those of you that haven't heard of Vanguard, they're a major global provider of ETFs and managed funds, and you can access them as a retail investor off market. Just go to their website and sign up. You do need a minimum of $5,000, but the beauty of it is that you can pay minimum of $100 into these funds over time. And if you just set that up as a weekly, monthly, fortnightly recurring payment, then the value of that, we talk about compounding, we talk about consistency, dollar cost averaging, and they also pay dividends that are reinvested. So it sort of combines everything into one that we sort of discuss. So I would encourage everyone to have a look at that. So it's a great vehicle, but certainly consistency. And if you don't want to pay brokerage, consistently, then certainly consistency in saving to invest, I think, is also important.
Yeah, definitely. It just made me think our very first piece of, I guess, hate mail came because we suggested that people shouldn't try and beat the market with their own stock picking 100% of the time. So I can't remember who wrote it, and we probably wouldn't want to call them out anyway.
No.
But if you're listening and you recognise that you sent that hate mail in, it was very nicely handwritten.
I wouldn't say hate mail, but yeah. Feedback.
Disparaging, negative feedback. I still think that, you, according to you beat the market this year, but I still think over the longest period of time, back testing, smarter people than us, some of the best investment minds in the world, have shown that it's a very small subset of people that can beat the market consistently. And if you just get market returns, just the vanilla market returns over a long period of time, you will do very well for yourself. So the most important thing when it comes to compounding is not having those massive down years, because that just kills any momentum you have in compounding. And the quickest way to kill that momentum is to try and pick your own stocks and pick incorrectly.
So has this changed the way that, how are you investing right now then that reflects this?
So
very, very briefly.
So similar to what we were saying, more than half of my money in stocks is in a variety of funds and ETFs and just getting market returns. And then just because not because I think I'll beat the market, but because I enjoy the exercise of doing it and learning. And, sometimes I get lucky, like with A2 Milk. There's my discretionary pot of money that I pick stocks with.
Yeah, nice. Cool.
Yeah. Same with you, or?
Yeah, well, that I'm a bit more heavy in cash than you are, which is something that I'm certainly reconsidering the more that we discuss this sort of stuff. The more I think about the longer term horizon, but then also, I've been thinking about my strategy of being in not all cash, but a fair chunk of cash for quite a while now. So I'm certainly going to sort of continue that approach, but of what I am invested in, a majority of it is in sort of listed investment companies and that sort of stuff. I think I only own about 2 or 3 individual stocks now. And, I've got the Vanguard thing ticking along and that sort of stuff. So yeah, I think definitely in line with what we've been discussing, but yeah, it's an interesting time for me because, as you know, a lot of cash, but considering now if that's the best move.
Yeah.
Keep you posted.
Yeah, but look, that as soon as you go back into the market, that's when things will go wrong. So just give us a heads up before you get back in the market so I can sell out.
All right, Ren. Well, that was a good one. So we covered costs, diversifying, and allocation. And as you said, it sort of all stemmed from, the general feel and questions that we were receiving from our Melbourne and I would imagine by this time Sydney shows. And if there's anything that does come up in the Sydney show that is worth addressing for those that weren't there, we'll certainly do that in a follow up as well. But costs, diversify, and check your allocation.
Yeah. And if all of this was confusing, I guess the most important thing is don't get hung up on picking stocks. Just start. just start. You can't do worse than me. I lost over 99% of my money on my first investment. I guarantee you won't do worse than me.
Well, you never know.
Yeah, there's a very slim chance that you will.
All right, Ren. Well, until next week.
Equity Mates and the people appearing in this program may have positions in the companies mentioned. This is general advice only. Please speak to a financial professional to understand how it may pertain to your individual situation.